Like in the
Yes.
history of mankind and things we've invented, it's such a powerful tool. Explain what that is and why it's important.
Yes. So what a cost segregation study does, it'll take a property, whether it's newly remodeled or newly purchased, and architects will go in and analyze the property and they'll identify certain assets that may not be structural assets. So they may not be part of the structural building portion that has to be depreciated over a longer life. So 27.5 for residential properties. And they could say that, well, this is an asset that could be easily removed. So it has a 5-year life, or it has a 7-year life, or it has a 15-year life, thus making it eligible for bonus depreciation. So that could yield some pretty significant tax savings because this is expenses that are not cash flow related. So it's really cash back in your pocket because you're saving on taxes
Is there
at
any
the individual level, at the investor level.
Right, right. So, I can basically take 27 and a half years of deductions in a
In 1 year, in one
one
year,
year.
yes,
Right. So for that
absolutely.
1 year, I could actually make money in
Huge
and
planning tool
huge
for the
money
real
for
estate
saving.
folks.
Yeah.
Yep, absolutely. And
Yeah.
again, this isn't cash out of your pocket. Yes, you probably have to invest at the onset for a study, but those studies can run anywhere depending on the complexity of the building and how big the structure is. But we've seen it 5,000 all the way to 15, 20,000 if there's huge multifamily structures. But the tax savings in that could be 3 to 400,000 of one time straight deduction, which results in pretty significant tax savings at the investor level. Now, this is only for federal. California and most of the other states do not conform to bonus depreciation. So there will be some differences between the tax treatment for the states.
Got it. Makes sense. Well, speaking about differences by state, I think SALT was also
Yes.
affected. I know it only affects, people making 500,000 or less, but it's pretty significant for those that, fall in that tax bracket.
Correct. So, with the Tax Cuts and Jobs Act that was enacted years back, it limited our state and local tax deduction and property tax deduction, and it set a limit of $10,000. Now, you and I both live in California, and we know property taxes, for most part, were well above $10,000. And then your state income taxes are well above $10,000. So that really limited individuals' ability to take advantage of these deductions. So now with the OBBBA, that increased the limit to 40,000. But as you mentioned, David, there is a caveat. High net worth individuals, those making over 500,000, their deduction is limited up to 10,000. So it's not going to go below 10,000, but they won't get the full 40. So for some individuals, yes, it's definitely a benefit. Those that are living in lower income tax states other than California probably will maximize on this benefit.